So, has the housing market crash finally begun? Well, the National Association of Realtors reported last week that pending home sales nationally dipped 2.8% from December to January. Month over month, that's a real dip. You know, with interest rates just now coming off record lows and supposedly so many people on the move out of crowded and suppressed cities into open suburbia and rural areas, I mean, how can that be? Well, there are many factors at play, and they are changing and evolving by the day. Now, it's not clear as to exactly what's happening, but something is happening. The market, it's on the move. Let's take a look. Hi, my name is Matt Theriault, CEO of Epic Real Estate, where we show people how to invest in real estate so they can escape the daily grind and retire early. And we do much of it by using creative financing strategies. And if that sounds like it's something up your alley, well, I've got a bunch of new stuff coming up this month, so make sure that you're subscribed to the channel so you don't miss it. For now, though, it's all about the imminent housing market crash. When is it going to happen? And what's going to cause it? Well, in the simplest explanation, supply and demand run the show. The more demand exceeds supply, the higher the prices get. And we're seeing that dynamic in an extreme state right now as the listing price for homes for sale grew by 15.4% year over year in January to $346,000. Yet, as prices rose, sales actually fell. So is that because the sales prices have become too high? Well, some people, they may think so, but it's more than likely due to the supply of homes for sale having fallen to a record low, down 25.7% year over year, while demand is unrelenting. Chief economist for the National Association of Realtors, Lawrence Yun, says, sales easily could have been 20% higher if there had been more inventory and more choices. So how did supply and demand in the housing market get to a point that we've never seen before? Because at the moment, I'd consider it a crisis. But could it be on the brink of seriously correcting itself? I mean, how would we know? Well, there are many places that we can look, in fact. So first, what may feel as an immediate contradiction of myself, stay with me. Because I'll say the supply and demand of the market may never totally correct itself. Here's what I mean. Big picture, the demand in real estate is the people. People need shelter, and that's not gonna change. We're growing as a population. People are making more people. Each generation is a little bit bigger than the previous. Now, big picture supply in real estate, that's the land. Now, that's fixed. We've got what we've got. We're not making any more land. So based on the big picture supply and demand conditions, we can expect values in the housing market to continue to drive upward indefinitely. I mean, there's enough demand walking the earth right now to promise that during yours and my lifetime, regardless of how old you are at the moment. This alone makes a very strong case for buying and holding real estate to be an extremely low risk, high reward investment. Despite the common consensus that real estate is risky, I'd comfortably and confidently argue the opposite. The risk, however, does come into play when trying to time the market when selling real estate. And that's almost impossible to do consistently with any certainty. But people, they continue to try. Thus, sometimes people lose. And here's why. There are many factors that can and will cause the supply and demand conditions to fluctuate along the way, causing prices to rise and fall and rise again. And many of these factors aren't even economic in nature. Consider COVID-19, which brought new construction to a halt. It paused home sales for a period as people stayed in their homes, and it caused building materials to be intermittently unavailable. That all happened and is happening. But what other supply and demand factors do we real estate investors need to closely watch? Because they're all on the move right now. Number one, mortgage rates. Now this is a biggie because as mortgage rates rise and fall, so too does affordability and the purchasing power of the consumer, which directly affects supply and demand. So if rates stay low, more people can afford to purchase a home. So demand goes up. Now, just last week, rates popped up above the 3% level for the first time since summer, and then slipped right back down under 3% the very next day. The bottom is being tested right now. Number two, builder confidence. New homes are built or not built, adding to the supply or taken away from it based on the comfort of builders doing so. And we can monitor their feelings based on the number of new housing starts and permits being pulled, of which tend to be leading indicators of when we can expect new supply and how much of it to hit the market. And right now, housing starts are as high as they've been since 2006, and builder confidence has just slightly pulled back from its all-time high, but historically still very high. So that would seem like new supply is on the way. But then we must consider number 3, building materials. The cost of materials will generally push housing prices up or down as builders pass on their costs to buyers. And with lumber prices having tripled in the last 12 months, builders will have to make up that cost on the sale to keep profits and production at stable levels. But current buyer demand is strong enough to offset these rising costs, at least for now. Then, just this week, breaking news suggests housing starts may hit the skids due to a lack of lumber and flat steel, 2 essential materials for building new houses. The price of materials, that's one issue, but their availability, that's another. And there's even more to consider. I mean, stick with me until the end, and you're gonna be the smartest person in the room the next time the real estate market comes up in conversation. Number 4, household incomes. The more or less people earn generally puts pressure on housing prices up or down. Low incomes are also symptomatic of an unhealthy economy, which is also likely to affect housing demand and prices downward. Loss of household income has been getting the headlines over the last year. But that income, it's not really lost, it's just gone elsewhere. Because many people, they did suffer financially during the pandemic, while just as many thrived. And many of them had record revenue years. Not to mention, U.S. household net worth soared in 2020 to surpass pre-pandemic levels. Now, closely related to household income levels is number 5, jobs. The more jobs a city, town, or state has available will dictate positive inward migration, incomes, and therefore demand for housing and what people are willing to pay for homes. So when unemployment rises, it typically increases housing supply and decreases demand, causing home prices to fall. And right now, this is a real key factor for us to watch, as the new official job report was just released last week, exceeding all expectations, having us currently sitting at 6.2% unemployment. Now that number has many people feeling like we're moving in the right direction, and maybe we are. But according to a recent statement by Chairman of the Fed, Jerome Powell, more than 5 million people have left the workforce completely and aren't being counted in the official job reports. Powell estimates that unemployment is closer to 10%. Now that's high, but so still are prices, weirdly. I went into detail in this video right here as to how this is becoming a more and more important issue for the housing market, and more on that in just a minute. Number 6, household debt. The more consumer debt someone holds, the less they can afford and the more susceptible they are to an economic downturn. If credit card debt increases dramatically, households may put off home buying as they pay down that debt, decreasing the demand for housing. The inverse is also true, because credit card debt dropped sharply in 2020 as consumers cut back, thereby potentially contributing to the demand that we're seeing right now. Number 7, local market factors. Positive or negative migration into a geographic area will have a dramatic impact on housing supply and demand. An unhealthy economy or an anchor employer shutting down is one example of local economic factors that will drive demand down. And what we're seeing right now, mass migration from big cities to the suburbs via health concerns, public safety concerns, and failing political policies. And that right there is actually in a category all by itself. And that's number 8, policy. Local and state level legislation and rules can have a dramatic impact on housing market supply and demand. I mean, consider favorable tax incentives and low development fees for builders. This makes it more economically feasible for builders to build new homes, increasing supply. High taxation, on the other hand, and heavy regulation and a slow building permit approval process can cause the opposite. And then there's national policy. You see, we have an entirely new leadership style in place, a new agenda in charge, and thus far, their actions have been bold. And their future plans are even more so. How that will impact the housing market isn't totally clear yet, but what is clear, there will be an impact. So as you can see, the housing market can be affected up or down by a myriad of factors, and they all put pressure on the supply and demand curve for housing, and they're all currently in play right now in a very big way. Real estate investors need to keep their eyes and ears on all of them. But here are the factors that pose the most immediate threat to the market. Regarding supply, while the inventory of homes for sale has hit all-time lows, there are some signs that more could be coming on the market in the weeks and months ahead. For instance, the U.S. Census Bureau and Department of Housing and Urban Development reported housing permits continued to rise in January, even while tight lumber supplies hindered housing starts. However, some critical supplies are flat out unavailable as of just last week, like the flat steel that I mentioned, that's needed for support to pour concrete foundations. Flat steel is in short supply due to a number of factors, including tariffs on imports and the supply chain impacts of COVID-19. No immediate solution in sight for this, by the way. Now, there is also a seasonal upswing in inventory we typically expect that can increase supply. And considering the economy is in the midst of its biggest attempt to reopen up since the initial pandemic lockdown, this positive seasonal activity is more likely than not, at least for now. Further, the mortgage forbearance programs, they're not going to last forever. Some are ending as soon as the end of this month, and foreclosures are likely to resume, of which will add to market supply. I went into great detail about this in this video right here. So overall, we should start seeing some adjustments to supply as soon as maybe just a few weeks from now, but mid-year for sure. But to what extent? We'll have to keep watching. Now, regarding demand, mortgage rates are key. They're important to keep our eyes on. While Jerome Powell last week told the Wall Street Journal that there is no plan to raise interest rates until labor market conditions are consistent with maximum employment and inflation is sustainably at 2%. Ironically, mortgage rates surged right after Powell's comments. So Wall Street seems to be taking his words with a grain of salt and moving with extreme caution. And one of the more operative phrases of Powell's comments was that there is no plan to raise interest rates until labor market conditions are consistent with maximum employment. And that would be the second thing we want to keep our eye on with regard to demand, jobs. Although unemployment continues its downward trend, albeit at a significantly slower rate over the last few months, initial jobless claims are maintaining at 700,000 plus per week, and they have been for quite some time. Now, to give that some context, that's still 3 times pre-pandemic levels, and still averaging on a weekly basis 100,000 claims greater than the worst week during the 2007 financial crisis. Treasury Secretary Janet Yellen issued a statement just this past weekend. These high rates of job loss threaten the well-being of workers and their families. They may create economic scars that last well beyond the end of the pandemic. It's a problem. When it comes to the housing market demand, jobs matter. Now, maybe something on the bright side. CareerBuilder.com reported last week that half of U.S. states show double-digit growth in job listings in February as companies look to rehire. For now, the bottom line, long-term supply and demand is overwhelmingly in your favor as a real estate investor. But the short-term supply and demand makers, amid a reopening economy, are now on the move, warning of potholes in the road and down the road. With real estate being the final frontier where the average person has a legitimate shot at creating real wealth, and if wealth is important to you, you now know what to watch for in the coming months. I'm watching, and I'll continue to share my thoughts on what I see, because everyone deserves a chance at wealth. And if you know something that can help someone else, it's just not cool to keep it to yourself. So I'll keep you posted. What did you find most valuable? Let me know below. And who do you know that may also need to see this? When their name comes to mind, please share it with them. Oh, and if you're already subscribed, I pulled this video out special for you to watch next. Otherwise, I'll see you next time. Thanks for watching. Take care.